I think the euphoria in stock prices is basically due to money creation by the Federal Reserve, and I think we're starting to see it in inflation. Over the last 6 months, the year-over-year increase in the CPI has been over 3.4%, and I think eventually...
Isn't that down from 4%? I mean, most of these commodity prices have plunged. I'm not saying there ain't no inflation. Brother Ozanian, can you put him straight?
I just don't know where he's coming from. I mean, this inflation scare was just a bogus scare from 7 or 8 months ago. Inflation rates are down all around the world, in this country, in China, in the UK, everywhere. Just move on. Think of something else to worry about. Profits are very near all-time highs. We had a 16% growth in S&P profits last year, a 0% growth in the S&P itself. So if we're up 3% so far this year, that's a small down payment on where we could go.
Don, you're not concerned at all?
You act as though money creation at the Fed is a bad thing. When the world is trying to deleverage, money creation is a great thing. Look at what the ECB is doing right now. It's doing 3-year full allotment, fixed rate, long-term refinancing operations that amount to giant QE for the Eurozone, which desperately needs it. The world is turning the corner, so don't miss it.
So you're not concerned at all that our debt is greater than our economy right now, or you're not concerned at all that our debt has doubled in 5 years?
I'm sorry. I'm trying to be concerned, but I'd have to stay awake.
Oh, you must have not been around in the late 70s.
Oh, for God's sake, please. I mean, come up with something new to worry about, okay? All this debt stuff, we're doing the right things. We've cut. We had a Budget Control Act associated with raising the debt ceiling that has made a down payment on budget control in this country. Austerity is the new order of the day throughout Europe. Just think of something else to worry about, all right? It's something. It's not that.
Talking about Europe, let's bring in David Malpass, the founding executive at Encima Capital and former Reagan Treasury advisor. Dave Malpass. So the story is Germany's GDP contracted by a teensy tiny bit in the fourth quarter. I think it was 0.25%. That's all. But they're still growing year on year, and their unemployment is actually coming down. And a lot of other reports on manufacturing are pretty strong. Do you buy the European recession? And generically, are you as pessimistic as my friend Ozanian here?
I was listening with interest to that conversation. I'm a bit in between, and I hate being in that position. But the reality is, Germany may keep growing, but the rest of Europe is falling into a pretty deep recession. So the concern for the U.S., I agree that valuations are attractive, and I agree with Don that the worries about the debt aren't where the growth consideration should be. Profit comes from hiring, from innovation, and that's going on. So my bigger concern is that Europe's banking system might still implode. They might do a fire sale where they sell all their assets, and we're not over the hump yet on Europe.
Why would they do that? This, as Mike Ozanian mentioned, the European Central Bank has given them these 3 years cheap money loans. All they want, there's more where that came from. To me, that's part of the problem. I mean, that's part of the solution. It's no longer the problem.
That's right, but it was only 200 billion euros net that they put in. And so they need to do 10 times as much, and it just doesn't look like it's in the cards to supply enough liquidity. The European banking system is $45 trillion. It's nearly 4 times bigger than the U.S., and the ECB is just 8% of that. It's a much smaller player relative to the size of the banks and the banking problem than the Fed has been in the U.S.
Mike Ozanian, what about the dollar? The dollar is strong. It's strong against the euro. Maybe that's euro weakness, but I think it's strong because the U.S. economy is improving, however slightly. It's improving. And secondly, the dollar's been strong against gold, which is down almost $300 an ounce. So doesn't that factor in as a bullish thing? This is like America's back. The dollar's back. You know what? We had Keith McCullough on the other night, distinguished hedge fund manager. He said the dollar really likes Mitt Romney, a free enterprise, pro-business kind of guy. Now, this could be the handwriting on the wall.
Larry, if you told me Mitt was going to win and he'd be president,
Mitt's going to win. I'm telling you.
Then I'd go long the dollar. Then I would go long the dollar.
You already missed 10 or 12% of the dollar, but that's okay.
You knew before I did he was going to win, I guess, but I loved his message last night. The problem with Obama's math is for every $1.5 trillion in debt he adds to our country, we see a ½ percentage point lowering of the unemployment rate. That's not going to get it done.
Now, Don Luskin, I do want to be fair. What if President Obama is reelected? How does that affect your strategy? I mean, the market will increasingly discount this as the year goes on.
Yeah, I think it's 50-50. I think it'll be a big upside catalyst if it became obvious that Obama would not going to get reelected. You know, I'm no fan of Mitt Romney, but if my choice is Obama and, I don't know, a trained chimp, I'm voting for the trained chimp. I think that would be an upside surprise. On the other hand, there's no surprise at all about what's happening in the Congress. The House is going to stay in Republican hands, and the Senate's going to transfer to Republican hands. Could you live with a world where we had an all-Republican Congress and a lame duck Democratic president? That worked pretty well for the late 90s. I'd do that again. How about you?
David Malpass, is that a Clintonian scenario, what Don Luskin just described? And let me complete the Keith McCullough metaphor, because he said Mitt Romney is half Reagan and half Clinton. And I'm sort of hearing that in terms of what Don Luskin just said. What you thinking about that, David Malpass?
Well, if Romney moves toward a flatter tax system, that's a huge positive change. And so I think that still is quite possible. Also, on the weak dollar policy that we've had under Obama, under Bush 43, that's been very harmful to U.S. living standards. So if you get some breather on that, that's going to be very positive.
I mean, would you say that, let me just get a quick whip around. This may be the question, didn't we actually? Is a strong dollar consistent with a strong stock market? Real fast.
Absolutely.
Don Luskin, strong dollar, strong stock market, because we went a year and a half where that wasn't the case. How about now?
There's no, you know, just look at the chart of the dollar versus the chart of the stock market over the long term. I defy you to find any correlation at all. It's all situation dependent. Don't even think about it.
Look at the Reagan years.
I can't think. Yeah, look at the Clinton years and the Reagan years. Dave Malpass, they've forgotten. These youngsters, they've forgotten. Their memories are so short, David.
We have a huge drain on the U.S. economy right now over these last 10 years as capital fled from the weak dollar. So if you could stop that, then all assets, for one, house prices would go up a lot if you stopped having the weak dollar, because all of a sudden
you're just mixing up cause and effect. You're acting as though we can wave a magic wand and change the exchange rate, and all of a sudden that is going to make everything else in the world change. The exchange rate is a product of the world. It's not the cause of the world.
Don, we've seen over and over again countries change their currency policy and their asset prices go up. That's Brazil in 2003. That's Russia, you know, on and on down the list. That's the U.S. in Ronald Reagan in 1982. We had a strong dollar and asset prices went up a lot.
Was the Plaza Accord about creating a strong dollar?
We'll have to leave the Plaza Accord for another time.